Welcome to today's explainer. Look, confession time. Have you ever felt that pure, almost rage-inducing frustration of staring at a chart, drawing what looks like the absolute perfect trend line, and then just watching the price smash right through it like it wasn't even there? Yeah, it happens to literally all of us. Trend lines are incredibly powerful tools, but the honest truth is, most traders out there are using them completely wrong. But today, we're changing that. We are moving away from emotional guesswork and getting into objective, rule-based execution. Let's really master the art of the trend line. Okay, let's dive into this. I want you to look at your charts and ask yourself, honestly, are you actually drawing these things right? Do you find yourself constantly second-guessing like, wait, do I connect the wicks here or the bodies? Or maybe worse, you keep falling for those brutal false breakouts, right? You jump into a trade, and then immediately watch your account bleed as the market just reverses on you. Hey, if you're nodding your head right now, don't worry, these are incredibly common traps, and we are going to fix all of them today. So, here's our roadmap for this explainer. 1. The trendline problem. 2. Tips for finding major swing points. 3. Practical, accurate drawing. 4. Strategy 1, the bounce. 5. Strategy 2, the breakout. And finally, 6. Summary and application. Quick and easy, right? Let's get to it. Section 1, the trendline problem. Let's look at exactly why most traders are failing here. Now that frustration, beginners feel, it's completely justified. You see the price touching a line you literally just drew and you rush in, right? You just assume, oh, it has to bounce here. But the harsh reality is that blindly entering a trade just because a candle kissed the line, while that's a fantastic way to blow up an account. Without a structured, really objective approach to mapping these out, trading trend lines is honestly no different than throwing darts blindfolded. We absolutely need rules. And before you draw a single line on any chart, you absolutely must understand the concept of a swing point. Think of it as your anchor. A swing point is simply that area where price moves in, creates a really noticeable peak or a valley, and then sharply reverses direction. These are the foundational anchors for literally any trend line you will ever draw. Make no mistake, if you don't have accurate swing points, your resulting trend line is just entirely meaningless. Moving on to section 2, swing point tips. This is all about finding those major pivots. So the crucial point is, how do you actually filter out all the chaotic market noise to find the anchors that actually matter? Well, look at these criteria. Rule number 1, only mark major swing points. Seriously, if you have to squint at your screen or try to, imagine a pivot, it's just not the one you need. It should stand out instantly, like a mountain peak, not a molehill. You're going to need at least 2 of these super obvious points just to start. Don't overcomplicate things by trying to connect tiny, random price ripples. You've got to focus strictly on the major highs and lows that dictate the real structure of the market. Alright, section 3, drawing accurately, the big wicks versus bodies showdown. Here it is. This is the classic debate that plagues literally every trading forum on the internet. Do we connect the wicks, or do we connect the bodies? Well, the answer isn't some rigid textbook rule you have to blindly memorize. Actually, the solution is beautifully simple. Just use whichever way gets you the most touches. That's it. If drawing through the wicks gives you 3 touch points, but say cutting through the candle bodies gets you 5 really solid touches, then using the bodies is the correct method for that specific chart. We are basically looking for market consensus here. More touches just means the broader market is actually respecting that level. Let's turn this into a super mechanical, practical 3-step process. Step 1. Scan your chart and identify those major glaringly obvious swing points we just talked about. Step 2. Draw a line connecting them in a way that maximizes the total number of touches. Again, regardless of whether they are wicks or bodies. And step 3, guys, this is the vital one. Treat what you just drew as the center of a wider zone, not a single fixed barrier. If you continuously practice this exact mechanical process, I promise you, drawing highly accurate lines is going to become completely effortless. Now this next part requires a massive shift in mindset. Way too many people take unnecessary losses simply because they treat a trend line as this rigid, static brick wall. It is a zone. Price doesn't have to touch your line down to the exact mathematically perfect pip. Markets are messy. They're driven by human emotion. As long as the price action is reacting within the general area of those connected swing points, your trendline zone is totally valid. Just remembering this one thing will save you from so many frustrating losses. Section 4, Strategy 1, the bounce. Let's talk about trading the rejection. Let's move to and see how this builds. We definitely don't just blindly buy when price touches our newly drawn zone, right? We need confirmation to protect our capital. And that's exactly where the stochastic indicator comes in as our reliable filter. Here's how it works. When price drops down and touches your upward trendline zone, I want you to look down at your stochastic. You want to see it cross down into the oversold territory. But hold on, don't enter just yet. Your final confirmation, your signal to actually pull the trigger, is when that stochastic line crosses back up and out of the oversold area. It's a really simple filter, but it completely prevents you from trying to catch a falling knife. Now, of course, even the absolute best technical setup in the world is completely worthless without strict risk management. The protocol here, it's non-negotiable. You place your stop loss safely tucked just below the most recent swing point so it's completely outside your trendline zone. And for your take profit, you've got to aim for a target that is at least twice the distance of your stop loss. Demanding this 1-to-2 risk-to-reward ratio is exactly what ensures you can stay profitable over the long haul, even if, especially since, you aren't going to win every single trade. And here is a fantastic pro tip pulled straight from the data. You should always be looking for confluence. Confluence is just a fancy word for when your trendline zone happens to perfectly align with a previous horizontal support or resistance level. When you find this, you are essentially stacking the odds massively in your favor. When two powerful technical barriers merge at the exact same price point, man, your probability of a successful bounce just skyrockets. These are those high-quality, high-probability setups that you really want to wait patiently for. Okay, let's pivot to Section 5, Strategy 2, the breakout, trading the reversal. Let's flip the script for a second. What actually happens when that trendline zone finally fails to hold the price? Well, before you rush in to trade a breakout, you have to beware of the ultimate trap, the false breakout. You've probably seen this. This is when price temporarily pierces the trendline, making you think, oh wow, a massive reversal is underway. So you panic, buy or sell, and then, boom, the price snaps right back into the original trend, just completely swallowing your account whole. Blindly entering a trade the absolute second the line breaks is literally just as dangerous as blindly entering on a simple touch. So how do we actually separate the real breakouts from the incredibly expensive fakes? By learning to read the market structure. Step 1. Look for weakening momentum before the break even happens. For example, in a downturn, price keeps making lower lows, right? But suddenly it fails to go lower and creates a higher low instead. Boom, that is your vital early warning sign. Step 2. Now you wait for the price to actually break through your trendline zone. And Step 3. Only confirm the trade when a candle closes completely and strongly outside the zone. A weakening structure paired with a decisive close, that is your true breakout signal. Alright, bringing it home with Section 6, Summary and Application. Let's put this all together. And this brilliantly illustrates our entire system. Let's just quickly lock in the core rules we've covered today. Remember this, above all else, trend lines are always zones. They're never fragile, microscopic lines. Don't waste time arguing over wicks or bodies. Simply maximize your touch points. When you're trading a bounce, protect yourself by using the stochastic indicator for that solid confirmation. And when you're looking to trade a breakout, always demand that the market structure shows you real structural weakness before you ever risk a dime of your money. If you apply this discipline, your trading accuracy is going to entirely transform. So I want you to ask yourself this: the very next time you open up a chart, what is the market structure actually telling me right before this trend line is broken? Seriously, don't just stare blindly at a line on a screen anymore. Learn to read the underlying story that those peaks and valleys are trying to tell you. Go open your charts right now, find those major swing points, and start practicing this objective approach. Thank you so much for joining this explainer, and we'll see you next time.